For more than a month, the market has vacillated, and that's putting it mildly, shifting sometimes day by day from big gain to big drop and back again. More confounding, some days, like yesterday, the market's rise is traced to weak economic data that might stay the Fed's tightening hand. Other days, like today, market gains are chalked up to good economic numbers, so go figure. So tonight, that's what we're going to do. We've invited two of Wall Street's best to help us and help you go figure. We'll call it the Go Figure Summit. Richard Madigan is Chief Investment Officer of J.P. Morgan's Private Bank, and Ed Yardeni, President of Yardeni Research, has probably made more smart calls on the economy and the market over the years than just about anybody. Welcome to you both. Richard, let's start with you. You say the Fed is not going to go cold turkey, which is certainly what Mr. Dudley seems to be saying. If I infer from that that you think this is not a bad time to invest and be in stock markets. It ain't over.
We have been in stock markets and took advantage this week for private clients to actually add a little bit into equity. I think the big debate for me in the market is continuing to make this an event. And it's going to be a process. And a process is going to be protracted with slow growth, low inflation, and a corporate sector that we've never seen stronger. The one thing I think that does have to change is people's expectations on returns need to come down a little bit.
Do you think, Richard, that we've overdone it on Fed talk? Do you think that investors have gotten off track from some of the basics like earnings, revenues, and just, corporate strategy?
Some of it's just emotion, right? At the end of the day, we forget that markets are people. And we've had a market that, for the most part, has gone up in one direction for 12 months. When you go up that far, and this year that fast, you tend to lose perspective on how high you are. And I think we were kind of grappling with what was going to be the provocation for more professional investors to take profits. And to me, that's a large part of what we've seen over the last 3 to 4 weeks.
Let's talk a little bit about bonds, which I know is an area you spend a fair amount of time thinking about.
Yes.
And I think that dovetails very nicely with your caution here to adjust your return expectations.
Yes.
A lot of people own a lot of bonds in their private accounts. What should they be thinking now?
We've been ahead of this. So when I think about how we've positioned private banking clients at J.P. Morgan globally, I think my theme has been don't overthink bonds. And for us, it's been sticking to very short duration. You're not going to make a lot of money. Manage your expectations. The income theme, be very careful about, because if you're focused too much on income, you may end up with bonds that have longer maturities. Those are going to reprice more aggressively. But keeping it very short in terms of maturities, laddering them and rolling them, I think, and waiting until you extend to higher interest rates, which we see out several years, is really the way we've been playing it. What we've been doing against that has been barbelling in things like equities. And we've been adding to equities in portfolios since last year, predominantly funded from credit markets.
Tell us more about going into equities, because we're at the halfway point of the year.
Yes.
It seems like we're at an inflection point for investors as they're getting out of bonds.
Yes.
They've got cash. Do they go all into stocks right now? I mean, what happens over the next 6 months?
Well, it's funny. Everyone who started this year saying we hate bonds, what always frustrated me the most in that conversation was they'd never tell you what to do in fixed income, and they'd lead the answer to be all stocks. Most of our clients don't need it to be the extreme. So we've said two things to clients this year. First and foremost, it's not a year to be out of markets. If you've been waiting for a world to normalize, this is the normalization. It's going to be protracted. Two, to be balanced investing. So we're now overweight equity allocations, but we've been much more balanced in that. We funded a lot of it from credit markets that have had phenomenal returns over the last 4 years. But I would caution not overreaching for risk either, because markets aren't cheap. They're fairly valued right now. We feel good about that.
All right, Richard Madigan, thank you very much.
Pleasure.
Always good to
Thank
see
you.
you.
Yeah,
Thank you
great
for
to
coming
see
out
you.
and joining us
Thanks.
on the set tonight.